find the exact same building, same price, same tenant. One walks away with a low-rate 30-year loan and almost nothing down. The other gets stuck with a short, expensive bridge loan and a balloon payment hanging over their head. Same deal, completely different outcome. The difference? They pick different financing. Commercial real estate has an entire menu of loans, and most people never learn it. Today, we fix that. I am going to walk you through every major loan type, who each one is for, and how to match the right loan to your deal. Let's go. Here is why this matters. Most new investors obsess over the property and treat the loan as an afterthought. That is backwards. Your financing sets your down payment, your monthly cost, your risk, and whether you even keep the deal in 10 years. The wrong loan can quietly drain more cash than a bad purchase price ever would. The good news? There is a right tool for almost every situation. You just have to know the menu. So let's lay it all out. Start with the language, because every lender speaks it. First, LTV, loan to value. The slice of the price the lender will fund. Lend 75% and you bring the other 25. Second, DSCR, the debt service coverage ratio. Does the property's income comfortably cover the loan payment? Most lenders want 1.25 or better. Third, amortization. The schedule your loan pays down on, often 25 or 30 years. Fourth, the rate, fixed or floating. And fifth, recourse. Whether the lender can come after you personally if the deal goes sideways, or just take the building back. Master these 5, and every term sheet suddenly makes sense. First loan type, the conventional bank loan. This is the workhorse. Your local bank, your credit union, your regional lender. Expect leverage up to around 75% LTV, with terms that often balloon in 5, 7, or 10 years even, while the payment amortizes over 25. These are great for stabilized income-producing properties when you have solid credit and a real relationship with the bank. The trade-off? Most are full recourse. You personally guarantee the loan. Flexible and familiar, but the bank wants you on the hook. Next, the small business secret weapon, SBA loans. There are 2 flavors. The 504 pairs a bank with a government-backed piece to fund big fixed assets like real estate. The 7A is the flexible all-purpose business loan. The magic is the down payment. You can often buy with just 10% down instead of 25 or 30. The catch? These are for owner-occupied property. Your business has to use at least 51% of the building. So if you run a company and you are tired of paying rent, SBA financing can turn you into the landlord for a fraction of the cash. Expect more paperwork, but the leverage is hard to beat. Now the fast lane, bridge and hard money loans. These are short-term, often 1 to 3 years, built for speed and for properties that banks will not touch yet. A building you are repositioning, a value-add play, or a deal you simply have to close fast. They lend on the property's potential, not just today's income, and they fund quickly. The trade-off is real. Higher rates and more points up front. This is a tool, not a home. You use it to stabilize or renovate. Then you refinance into cheaper, long-term debt. Powerful when you have an exit plan, dangerous when you do not. Stepping up in size, CMBS, also called conduit loans. Here, the lender bundles your loan with many others and sells them to bond investors on Wall Street. Why care? 2 big perks. 1, they are usually non-recourse. Your personal assets stay protected. 2, they fund larger, stabilized deals, often a few million and up, at competitive fixed rates. The trade-off is rigidity. Once the loan is sold off, it is locked in a trust. Prepaying early gets expensive, and flexibility goes out the window. Great for a stabilized asset you plan to hold for the long haul. Finally, the premium tier. Agency debt, through Fannie Mae and Freddie Mac, is built for apartments and multifamily, with strong leverage up to around 80%, and some of the best rates and terms you will ever see, frequently non-recourse. Then there is life company debt, funded by big insurance companies. They want the trophy assets, the best buildings, the best locations, the strongest borrowers. and in return they offer the lowest long-term fixed rates anywhere. The trade-off for both? Strict standards and a high bar to qualify. But land one of these, and your financing becomes a genuine competitive advantage. Let me put one number in lights. On a qualifying SBA owner-occupied deal, you can often get in for around 10% down, versus the 25 or 30% a conventional commercial loan typically demands. That is the same building for a fraction of the cash out of pocket. Choosing the right loan is not a detail. It can be the difference between closing and walking away. Let's put the two most common choices head to head. On the left, SBA, as little as 10% down and long friendly terms. But you have to occupy the building and you will fill out a lot of forms. On the right, the conventional bank loan. Plan on 25 to 30% down, but it works for pure investment property, it closes faster, and it is far simpler. The rule of thumb, if you are a business owner buying your own space, SBA almost always wins. If you are a passive investor or you need to move fast, conventional is usually the better fit. Now, the mistake that burns people again and again, shopping on rate alone. A headline rate means nothing if the loan balloons in 3 years, locks you into a brutal prepayment penalty, or puts your personal assets on the line. Picture a low-rate bridge loan with a balloon you cannot refinance when rates jump. That low rate just became a crisis. So look past the rate. Ask how long the term is, whether it is recourse, and what happens at the end. The best loan is the one that still fits your plan 3, 5, and 10 years out. Let's lock it in. Learn the 5 words first. LTV, DSCR, amortization, rate, and recourse. Conventional bank loans fund stabilized deals around 75% leverage, usually with recourse. SBA gets you in for about 10% down, but only if you occupy the building. Bridge and hard money buy you speed for transitions, while CMBS, agency, and life company debt deliver size, the lowest rates, and often no personal guarantee. Above all, match the loan to the deal, and never ever shop on rate alone. Ready to put this to work? Start by running your numbers on the calculator at maxlifedevelopment.com. Then let's talk through the right structure for your deal. I am Ryan Solberg with MaxLife Commercial, and we help investors across Central Florida and the whole state find, finance, and close commercial real estate the smart way. Call us anytime at 321-586-2121. Let's get your next deal funded. I will see you in the next one.